This is an Uncover Japan company research report on Tenpos Holdings, ticker 2751. Tenpos buys kitchen equipment from restaurants that close, refurbishes it, and sells it to the restaurants that open next. It has built a rare national reuse loop around that activity, then added restaurant services and a growing restaurant roll-up. The central question is whether that expansion can turn a compelling operating model into sustainably profitable growth. The snapshot captures both sides of the case. At the report date, Tenpos traded on about 20.2 times forward earnings and 2.53 times book value, with a fiscal 2025 return on equity of 13% and an equity ratio of 60.2%. The company is effectively net cash and financially resilient, but the market already values it as a growth story. Investors are not being offered a deep asset discount. They are being asked to trust the next stage of execution. Tenpos monetizes a restaurant across its life. When an operator closes, it can buy the kitchen equipment at a low cost. The equipment is refurbished, stocked, and sold through large showrooms to new operators who need a complete kitchen quickly. The group then offers staffing, premises, promotion, and financing support through its services arm. More recently, it has acquired restaurants itself. This lifecycle is important because it links industry churn, equipment resale, and service relationships into one system rather than a one-off transaction. The segment mix reveals the economic engine. Kitchen equipment retail contributed 58% of fiscal 2025 sales and an 8.4% operating margin. It generated roughly 90% of group operating profit. Restaurants accounted for 34% of sales, but earned only a 2.2% margin. Information and services is smaller, but strategically useful, connecting Tenpos to restaurant owners beyond the equipment sale. The tension is immediate. The high-margin core funds the growth business, while the growth business dilutes the group margin. Revenue rose from 27 billion yen in fiscal 2021 to 47.1 billion yen in fiscal 2025, a 14.9% compound annual growth rate. Yet operating profit peaked in fiscal 2024 and eased in fiscal 2025. The operating margin fell from 7.6% to 5.7% as lower margin restaurant revenue became a larger part of the group. Revenue growth is visible and real. The harder question is whether the business mix can improve enough for operating profit to resume its upward trend. The balance sheet provides an important cushion. Tenpos has an equity ratio near 60% and is effectively net cash, giving management capacity to invest through a difficult restaurant cycle. But that does not make cash generation automatic. Operating cash flow moves with working capital, and free cash flow turned negative by about 2.1 billion yen in fiscal 2025 as acquisitions absorbed capital. For this company, it is sensible to watch operating cash flow, acquisition discipline, and the return earned on reinvested cash together. The core moat is not manufacturing. Tenpos is close to the only listed Japanese company operating a nationwide chain for second-hand commercial kitchen equipment. It needs both sides of the market at once: buyers who can source equipment from closing restaurants, and a network that can appraise, refurbish, warehouse, and sell it quickly to new ones. Its showrooms and pricing know-how matter because buyers want real equipment, low upfront cost, and immediate availability. The major equipment makers are suppliers and complements. Tenpos' advantage is organized reuse and distribution. Management's direction is clear. With fiscal 2026 revenue guidance of 57.7 billion yen, Tenpos aims over time to build a 100 billion yen group. The restaurant business is intended to reach 50 billion yen through acquisitions. The strategic logic is that owned restaurants become customers for equipment, services, and operational support. That can deepen the flywheel. But the goal is an ambition rather than a dated, audited plan. Its value depends on profitable integration, not the headline size of the group. This is the make-or-break issue. The restaurant segment earns about a 2.2% operating margin, compared with an 8 to 11% range in the retail segment. If acquired restaurants improve through shared staffing, promotion, equipment, and back-office support, the roll-up could strengthen the group. If their margins remain low, Tenpos risks buying revenue while group profitability stagnates. The indicators to watch are specific: restaurant segment margin, group operating profit, and evidence that owned restaurants generate incremental high-margin equipment demand. Capital allocation makes Tenpos a very particular kind of holding. Its dividend yield was only 0.26%, with a payout ratio around 5%, and no buybacks since fiscal 2021. Comparable equipment makers offer roughly 2.3 to 2.5% yields. Tenpos retains almost all of its cash for stores, inventory, and restaurant acquisitions. That is coherent for a founder-led growth strategy, but it means the shareholder return is almost entirely an earnings growth bet, rather than income paid while investors wait. The report's 3-year scenarios are a framework, not price targets. The bear case reaches 1,580 yen if integration stalls and the multiple D rates. The base case is 3,360 yen, close to the report date share price, assuming gradual improvement. The bull case is 5,980 yen if the restaurant roll-up scales profitably and the growth multiple holds. The asymmetry is the message. At a full valuation, the upside is conditional on execution, while disappointment can hit both earnings and the multiple. Tenpos Holdings has a differentiated and defensible business, a nationwide restaurant equipment reuse loop, a cash-generative retail core, and a strong balance sheet. The founder-led strategy to reinvest into restaurants is active, not hypothetical. But the shares already reflect a successful growth narrative, while the acquired restaurant business remains low-margin. The research score is 12 out of 20. The central test is simple. Can restaurant margins improve without weakening the retail engine? That answer, rather than revenue growth alone, will determine whether the story earns its valuation. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.